What's up, everyone? Drew, aka Catching Rockets here. I hope everybody's having a great weekend. Hopefully, everybody's been spending time with family and friends. I don't want to be too political, but I feel like it needs to be said. Hopefully, whatever's going on war wise ends quickly without too much loss of life, and obviously praying for our troops. But really, just don't want to see anybody get hurt no matter what side they're on. With that said, anyway, just kind of hits close to home, you know. Come from a long background of service members. I'm a vet myself, disabled vet, and nothing but respect. With that said, something else I want to cover really quickly. I am not a professional YouTuber. You might hear my wife in the background. You might hear my baby crying. I don't know. You might hear my dogs barking. It is what it is. I'm a trader. I like to teach about trading. And what I can tell you is I will be conveying some amazing information to you today. It might not be done in the most professional manner ever, but the information is going to be spot on and precise and quality. And to me, that's what matters. The next thing I want to add is hopefully everybody watching today has watched the class I did on volume profile, I think last week. If you haven't, definitely go and watch that. Because if you combine volume profile with what I'm about to teach today, it really kind of unlocks the matrix of trading. And then lastly, don't let me forget to do this. I'm going to give, I don't know what to call it, but I'm going to provide everybody with a link to my Quantower settings. That way you can just import it onto your chart. And then you'll be able to see exactly what I'm looking at, kind of thing. And I'll also be going over very briefly Quantower and like how to use the different order flow or different footprint settings that I look at when I'm trading. Okay. All right. So with all of that said, let's hop into this. And hi, everybody. So order flow, footprints, and imbalances is what we're going to be covering today. Hopefully my volume's good. What is order flow trading? Focuses on analyzing actual buy and sell orders. Goes beyond traditional candlesticks or volume charts. Provides real-time insight into market participant behavior. Order flow trading is about reading the transactions happening inside the market, seeing who is buying, who is selling, and how much. This technique is widely used by institutional traders and gives a real edge by showing market intent in real time. Just an FYI also, I'm not going to be just reading slide by slide. But for the intro, I've got a couple of slides that I'm going to be reading verbatim. And then from there, we'll be doing more teaching, like with an image of an actual chart. Why order flow matters. You can see what's behind the candles, spot liquidity zones, identify institutional activity. You can also spot like trapped buyers and sellers. Candles and indicators show what has happened. Order flow shows what is happening. That real-time view helps traders anticipate reversals, continuation patterns, and volume-based setups more accurately. And we're going to be going into depth on actual like setups, how to trade them. And I also should quantify, this is really targeted at people that are trading futures. If you're not trading futures, you should consider switching to futures. There's nothing wrong with trading futures and options or whatever else. A lot of traders that I know that trade futures also will trade options as well. But I've never met a single person that switched from options to futures and regretted doing so. But like I said, even still, a lot of people will still, that trade like futures primarily as a day trader. We'll also still take option trades here and there, and we'll swing trade, options at key levels. So the first thing we're going to be talking about is the DOM, which is depth of market, which is our pending orders. Oh, I forgot an exclamation mark here, but whatever. So on this side, the left-hand side, we have the bid. And when I'm talking about this, I want you guys to try to think about, yourself as a trader. Because even if you're trading options, right, we're still using bid and ask. I'm going to be posing some questions as we go through this that I want you to actually think about. And so primarily the bid side is considered the buy side, right? And the ask is considered the sell side. So the DOM provides a lot of information, but a lot of these pending orders never get filled. So a lot of times if you see like a level with thousands of orders, a lot of times the market makers will put those orders there to try to push price in that direction, making us think that there's a big order sitting there, and then we try to follow suit, right? But a lot of these pending orders never get filled. These orders are only placed to move the market in the desired direction. When price gets close to them, they are in most cases withdrawn. And this is being done by computers. If you watch the DOM, these things can move so quickly that like us as a retail trader trying to like quickly remove an order before it gets filled would be very difficult to do, because it takes just a fraction of a second for price to get there. The big advantage of using order flow is that it prints orders that actually got filled, or orders that matter, orders that actually got filled. So on the left-hand side here, we have our bid, and these are actual orders. I can't show it to you real time, but you can watch this real time and you can see the orders actually being filled on the bid, and we can also see the orders being filled on the ask. Again, bid considered the buy side, ask considered the sell side. So are all orders on the bid buyers, and all orders on the ask sellers. This is something I would like for you guys to take a second to think about. You yourself, when you're entering trades, do you enter only buys on the bid and only sells on the ask? Or are you also entering sells on the bid and buys on the ask side? Passive market participants. So these are market participants that are waiting for price to come to their level, right? So on the bid, I have my passive buyers. So as price comes down, so right now there's 67 passive buyers here, 166 passive buyers here, 188. I'm not going to read all of these, but as price comes down to whatever these levels are, these people are going to get filled as price gets there. On the ask side, we have our passive sellers, which means if this is the current ask, if price comes to here, then these people are going to start getting filled. To here, they'll start getting filled. To here, they'll start getting filled. So basically, as a green candle is pushing up, it's going to start filling these orders, right? So if you open a long position, this would also be considered our calls with a limit order. Then it would appear on the bid side, right, of the footprint chart on the left. If you opened a short position or also puts with a limit order, then it would appear on the ask side of the footprint on the right side of the chart, or on the right side of the candlestick. Active market participants, this is our aggressive buyers and sellers. If you open a long position or calls with a market order, it will appear on the ask side. So on this side, we have aggressive buyers. We don't see them because they're getting filled here where the zero is. It just fill, fill, fill. As soon as they hit market, they're getting filled, but on the ask side. So aggressive buyers will show up on the ask side. If you open a short position, or also what would be considered puts, with a market order, it will appear on the bid side of the footprint on the left. So they would show up here at the 0, getting filled as aggressive sellers or puts. This is a very important concept for people to understand. Can there ever be more or less buyers? And within that, I didn't want to type too much, but also the same question, could there ever be more or less sellers? This is something I want you to think about before I start talking. But just as an example, or actually, sorry, let me just start reading off of the slide. Can we ever have an incident in the market where there are more buyers or more sellers? So the answer to that is going to be no. And people really struggle to wrap their head around this. But if you've ever tried to buy like an option or buy even a share of a stock that has low liquidity, you can place your order even whatever at the ask, right? And your order will just sit there and sit there and sit there, and it doesn't get filled. And the reason it's not being filled is there's nobody selling at the price that you're asking for. So I've included a scenario where I say, if anyone's willing to sell an ounce or more of gold for $100, I'll buy all of it. DM me, email me, whatever, reach out. I will buy 1 million ounces of gold for $100 each. So there's probably people trying to sell gold, or I know for a fact there's people selling gold right now today. But nobody is willing to sell an ounce or more for $100. So even though there is a buyer, me in this case, right, willing to buy an ounce or more for $100, nobody's willing to sell it to me for that price. So in this instance, I'm buying, but nobody's willing to sell at that price, right? So whenever we have a transaction on the stock market, we have two people agreeing on price. One person is buying and one person is selling. If there's nobody selling, then I can click buy and I'm not going to get filled. Or the inverse, this happened with GameStop thanks to brokers like Robinhood and a few others. They were the way that they were able to prevent the short squeeze from happening is they remove the buy button. And if Robinhood is one of the main brokers that people were using back then, they were like really interested in like GameStop and AMC. If that particular broker, has the largest number of people that are looking at stocks like AMC or GME, and that particular company removes the sell button, or sorry, the buy button, I apologize. They remove the buy button. So now all I have is sellers and nobody can buy. So what happens is, as I know there's a way to draw in here, but I don't know how, and I'll just mess it up, and I don't want to do that. But basically, if I have people just trying to sell, let's say at $100, and there's nobody buying, then next they try to sell at 99 and there's still nobody buying. So then they try to sell at 98, 97, 96, so on and so forth. And the price just keeps shooting down because these people are trying to aggressively sell their shares, but there's no buyers because they remove the buy button, right? So this is a perfect example of, for every transaction, there has to be a buyer and there has to be a seller. Without both, you can't make a transaction. Just like during COVID, if I walked into the supermarket and said, hey, I want to buy toilet paper, and the cashier just laughs at me like, that's nice, so do I, but there's none available, right? It doesn't matter if I want to buy it. If it's not available, then I can't buy it. It might be available at a different price. Like at that time, if I was willing to buy it, from another avenue, like on Amazon, people were price gouging toilet paper. Obviously I can buy toilet paper. I just might have to pay a premium price. I'm not going to be able to buy it at retail unless I just happen to be lucky and walk in as they're stocking the shelves. So same thing with stocks. We need a seller and a buyer for a transaction to happen that both agree on the same price. So to put this all together, on our bid side, we have our passive buyers, and on the ask side, we have our passive sellers. On the bid, we also have aggressive sellers, and on the ask, we also have aggressive buyers. If it was as simple as buyer-seller, trading would be so simple that everybody would be insanely rich. So if we put this all into one footprint to sum this all up, on our bid side, we have aggressive sellers at the top. We have passive buyers that show up below the zero, right? Down here. On the ask side, we have our aggressive buyers at the zero and our passive sellers that show up here, right? So it's never as simple as green buying and red is selling. It's never that easy. So bigger perspective, to put things into a bigger perspective, let me show you one more thing. Maybe you've seen some volume profile indicators with two colors and the developers told you that one color shows sellers and the other color shows buyers, like this one, for example. So people mistake this as aggressive buyers here, but this is aggressive buyers or passive sellers. We have a combination of both. And then on the inverse side here, we have aggressive sellers or passive buyers. So both buying and selling is happening in both areas on this. So if somebody tells you one is buying and one is selling, they do not know what they're talking about. I forgot to mention one thing, which I'm going to get into really quickly here while I'm thinking about it. Most of what I'm teaching today, and when I say most, some of this I learned from my mentor, Shorty. A lot of this information is taken straight from Trader Dale's book volume profile. Or sorry, I apologize. Straight from Trader Dale's book order flow. I'm going to link that in the chat. That's an affiliate link for Amazon. So if you do use that link, I get a little kickback. But also, sorry, I'm typing really quick. If you go straight to Google or whatever search engine you use, type in order flow by Trader Dale, click on order flow ebook download on Trader Dale or trader-dale.com. You can come directly to his website and click download now. And it's going to ask you for, oh, it didn't ask me for anything. Here's the book. So you can just literally download this directly from his website. Okay. So completely for free. I prefer physical copies of books. I use the, I did download the free digital version, which I use when I'm teaching. But I prefer to have a physical copy of a book, for my own reading. So like when I'm, sitting down and reading on my own, I prefer physical books. So basically a lot of what we're covering today is going to be covered in that book, and highly recommend that you read it. I'm basically doing Cliff Notes, so I would definitely read through that book to get a little bit more knowledge. So based on what we just discussed, we know when volume appears on the bid, they can both be aggressive sellers or passive buyers. And when volume appears on the ask, they can be both aggressive buyers or passive sellers. If someone tells you green is a buy and red is a sell, they're telling you a half-truth. Footprint candles. This is partially what I look at when I'm trading. So on one screen, I'll have my footprint charts, and on another screen, I'll have my, why can't I think? Trading view chart with regular candlesticks. And on my trading view chart, I mark my levels, previous day, value area, high, low, POC, whatever, previous week, previous month, previous year, so on and so forth. But so in this example here, we have a bearish footprint candle with negative delta. I'm going to break all of that down. So the bearish part is in the middle, you can see there's a red candle. This is, just like our regular red candles that we trade with in TradingView. Up here at the top, we have our delta, and in this instance, it's negative 4,521. On this side, we have our bullish footprint candle with positive delta. So here our delta is 309, and this green candlestick in the middle would be just like our regular green candlestick that we see on TradingView. The difference is here we have the orders that are actually, like, as they happen, we can watch the order flow coming in. So in this instance, this is our bid side and this is our ask side. Same thing over here, bid, ask. Bullish candle with negative delta in conjunction with support levels. So this particular trading setup that I'm going to be talking about is not a standalone trading setup. So you want to be using this in conjunction with volume profile. So, or whatever resistance levels or support levels you might have on your chart. I say volume profile because that's what I use, but I also will look for key support resistance levels. Again, I talked about that in the previous class, so I'm not going to talk about it again today, but this is something that you would use in conjunction with that, right? So in this instance here, we have a green candle, right, coming up with negative delta. So we have an inverse relationship here where price is pushing up, but delta is going negative. What that's showing us, and especially if we have like whatever it is, like previous day value area high right here, we're coming up to a key resistance level, and you're seeing negative delta on a green candle. That's a place to look for a reversal, and that would be your confluence. So like a lot of people will talk to me like, I'm using volume profile and I never know like what levels are going to be respected, what levels are not going to be respected. I never know whether I should be entering a short or a long at a key level. This is your confluence that tells you whether or not you should be entering short or long at a key level. And in this instance, I'm just using 5-minute candlesticks. So again, if we were coming up to a key resistance level and we see negative delta on a green candle, that's where you would slap puts, or that's where you would slap short and then take it down. In this instance, this gave a 20-point move on ES, and that might not mean very much to some people, but I'll do the math for you very quickly. If you don't know futures, ES for every 25-cent move is $12.50. We multiply that by 4, which gives us $50. So every $1 move on ES is $50. Multiply that by 20, and you just made $1,000 off of one contract for recognizing the negative delta green candle coming up to a key resistance level. Okay. The inverse of this here, we have a bearish candle with positive delta, again, used in conjunction with support levels. So our delta is 46 on our red candle. So we're coming down, and from there, this is where you would slap, calls or go long and take your trade up. Okay. A little bit later in the video, we'll be talking about how to figure out like where to exit your trades based on this information as well. Volume clusters. This is a standalone strategy. Also look for volume clusters in a trend, which I'll be talking about in a little bit. But so to use this strategy, I told you guys at the beginning of the video, I'll be sharing sometime at the end of this video, I'll be sharing my cluster chart that I use on Quantower, and that way you guys can basically use exactly the same settings that I use. But to get to this particular chart, this is so like our previous chart shows, the bid and the ask, so we see volume on both sides. This chart only shows the combination of bid and ask together, so we just see where large orders are coming in, right? And if you compare like to other places on the chart, you can see that our volume is significantly higher through this area, or actually these areas right here, these 3 blocks, right? Compared to everything else that we're seeing. But anyway, if you did want to use this, you would click on cluster on Quantower, and under type, you would change it to single. And again, I'll be sharing that towards the end of the class. I mean, I'll post it in Keenan, so you can basically download it anytime. I'll also show you how to apply it to your charts. I will also be sharing, basically, because this is a question I get asked a lot. If you want access to these charts, I will share with you how to get it if you're wanting to trade with cash, and I will also share with you how to get these charts if you want to trade on a prop firm. Okay. Next slide. So this is the same, and when I drew this box, I apologize. I should have really highlighted all 3 of those nodes, but I just highlighted the main one. This is where the most significant volume occurred on our chart. But really, I should have grabbed this whole area, but I didn't. Anyway, the key thing that we want to see in a trade like this, and it's even better on a higher time frame. This is a 5-minute time frame. But if you use this like on a 30-minute time frame, you want to see a full body candle that opens and closes below this level. Or the inverse, if we're looking for longs or looking for calls, we want to see a full body candle open and close above this level, right? And so then once that happens, once we have, and really what we're looking for, I'm sorry, I'm going to be more specific, like 2 30-minute full body candles closing or opening and closing below this level. If you want to be a little bit more risk averse, you can do this on 5 minutes as well. Just know your success rate isn't going to be as high as like 2 30-minute candles opening and closing below the level for shorts, or opening and closing above the level for longs. Excuse me. So in this instance, you can see we left, price moved away from this large order flow that was coming in up here, got pushed down. We had several, 1, 2, 3, 4 full body candles that opened and closed below this level. And when we came back and retested it, if you just slapped short or slapped puts, you would have ended up getting paid. And we'll show that on the next screen here. So this was our key level here. Price moved pretty far away from it. We came back up to it and rejected down to here. And I want you guys to recognize, or I'm not going to talk about this specifically right now, but I want to point out there's a large volume here, right? So if we compare up here, we had like 33 something, I don't remember the exact amount, but 3,300 and some change. And down here, we have another order for 3,000 right down here. Okay, so like this volume here is even more significant than the volume happening here, right? So anyway, if we went short here, this is 59.97 down. This is 59.86. This would give you, you know, like targeting that volume, roughly a 10-point move on ES, which is $500, right? But then they went and retested the level and actually ended up selling off even lower, right? So this is just our large volume blocks without looking at the bid and the ask. We're just looking at large orders coming in on the tape. The next standalone strategy we're going to be talking about, I had to basically steal Trader Dale's chart. This might not make sense to some people, but the contracts just changed from ESM to ESU, and there's not very much data, so I can't go back and look to find like setups to show you guys. I just had access to the screenshots that I had already taken that are in my screenshot folder, and I didn't happen to have one of double nodes. But this is probably one of the hardest setups to find, where we have, and this says POCs, so stacked node POCs. The yellow line on these charts, or I guess in his case, the dark gray line that he has. So on my charts, these are going to be yellow lines. That's awesome, Robert. It looks sick. So on my chart, these show up as yellow. On his, he has them as like a darker gray. Again, mine will show up as yellow. This is here. This is here, 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 here. So this is the POC for each candlestick, right? And he's looking at a 30-minute time frame. He's found, well, some of these it looks like are during regular trading hours. Oh no, that's 1800. I like to look for these during the New York session. I mean, you can use them, you know, pre-market, after hours, whatever else, London session, Asian session. That's entirely up to you. I've just found they're way more effective if I use them only when I find them on the New York session. And I'll explain that in a second. But where we see like a double node like this, you would basically just put, you know, like for me, I would draw a line on my chart basically saying this is a double POC node. And the next time price comes to there, I'm going to enter short or enter into puts, right? And so this double node, this double POC node, it's kind of the same. We're looking for almost the same setup that we were just talking about with the high volume nodes, where we're looking for 2 or more full body candles to close below this level, or 2 full body candles to open and close above this level. If it's below, when we come back to this area, we're looking to short, right? And if it's above, when we come back to the level, we're looking to grab calls. For me, this is one of the most monotonous trade setups to look for. And when I say that, I really need to quantify it because they don't happen very often, right? If I'm looking for them on 5-minute charts, I might see quite a few. But what we're looking for on these large volume nodes, or the double nodes, or even triple nodes in some cases, or more quadruple nodes, I'll explain what it is. If I'm an institutional seller, let's say, like I'm trying to get in short here or get puts here, and I put a large amount of orders at this level on a 30-minute chart, you know, like from there, the people see the orders start coming in, it pushes price down. And let's just say I was trying to get, like in this case, like 5,000 contracts, right? Is 5,000 enough? Let's say 6,000 contracts. And so my initial sell order starts pushing price down. And then the next time price comes to there, I start getting filled in that price range, and we start seeing a lot more orders coming in at the same level. And I've placed so many orders that the highest order volume is coming in at that level. So that creates our POC, right? And then from there, you know, even with those large orders, like price still pushes through it a little bit. But this whole time, this seller here is defending this position and selling, 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 selling. And the theory is if I put, let's say, 6,000 orders or 7,000 orders here, I only got partially filled on those orders. So when price moves away and we have full body candles opening and closing below, that's confirming that this was a seller that was putting in those large orders. And the next time price comes to there, he's still got a couple thousand orders remaining that he's wanting to get filled on for the rest of the move down. So the next time price comes up to here, we as retail traders want to follow this guy or this lady, whoever it is. And so we're going to slap puts or slap short at that same key level. Okay. And again, inverse, if this orders come in and then we have full body candles open and close above the level and then come back to it, in which case we'd be looking to get in long or get in calls. Okay. Imbalances. This is also a standalone strategy. This is probably one of my favorite strategies to trade off of. And we're going to quantify some very important things about imbalances. I haven't watched anybody else's classes on imbalances, so hopefully they covered the same information. All I can do is teach what I know and teach it how I know to teach it and teach it how I trade it. There's just a very key thing about imbalances that's really important, which is we're not interested in imbalances that happen in the middle of a trend. And what an imbalance is when we're looking at order flow. So on the left-hand side, we have our bid. On the right-hand side, we have our ask. And it's always diagonal. So like this 1, if we were to go down here, it would be a 0 and 1, right? So there was no more people selling, just buyers. And so then here we have a 0 and a 2. For me, this 2 is highlighted as a green color, which means 2 is 300% higher than 0, right? And then the same thing here. This happens to be the POC of this candle, so we can't see it, but this 2 would be green as well, which is 300% higher than 0, right? On my chart, the red numbers are going to be 600% higher. And I don't see any right now, but yellow numbers are going to be 900% higher. So in this case, and you can see like, if I have 2 stacked red numbers together, it's going to print a red box, right? If I have 2 or more, so in this case, I have 4 green numbers stacked together, it's going to print a green box, right? That goes across my screen. This is a good thing to notice right here. We created a red imbalance right here that went across, but it's in the middle of a trend, right? Or almost at the end of this downward move. And then from here, we came back up to that level, and we sold off from there. And we created a pretty large imbalance on this candle where it created like a 4 stack of imbalances. And normally you would expect like when price comes back to there for it to reject down. But what I don't like about this is this occurred in the middle of a trend, or almost towards the end of a downward move or the end of a trend. And then from that level, we basically printed a sell side imbalance. It was at the beginning of a trend, but it's the same level that happened in the middle of a trend or at the end of a trend. And we're not interested in those. And that's the distinction of what I want to convey to you guys is if I'm looking to get into an imbalance in a buy side imbalance where when price comes back to here, I want to be long or I want to be in calls, I want it to happen at the beginning of a trend. Like this one here in particular, I would have even preferred if it was down lower, but it's here. It is at the beginning of a trend. I would prefer if it was closer to the bottom of the trend than where it is right now, but that's okay. I actually took this setup. It's marked on my chart. And I believe I covered this on one of my live streams like last week sometime. And also I want you guys to notice this was on June 3rd, right? So this single print came in, or sorry, this imbalance was created on June 3rd and prints this line across my chart. So the next time price comes to there, we're looking to get in long or we're looking to get in calls. Again, we're only interested if it's at the beginning of a trend. So if it's at the beginning of an uptrend, we're looking for calls or longs when price comes back to this. If it's at the beginning of a downtrend, we're looking to get in puts or get in short when price comes back to this. And then you'll also notice up here, I'm on a 30-minute chart. You'll see a lot of imbalances on 5 minutes or lower time frames. When you start seeing imbalances at the beginning of a trend on 30 minutes or higher, be very, very interested. Make sure you mark them on your TradingView chart so that the next time price comes to there, you're ready to slap that buy or sell or whatever it is. So again, June 3rd, 2025, next slide. This is where price finally came back to it. And we're now June 19th. Also notice we had imbalances that were created in the middle of trends. Like they did get so this one here was completely unrespected. Price went through it. This one here was completely unrespected until it came down to this imbalance here, and they did give a small bounce. But if you look at the difference, like that a bounce gave from an imbalance that was occurred in the middle of a trend, or even here completely unrespected, right? Or I mean, it did give us a little bounce, but if you compare it to that imbalance that we were watching from June 3rd, these gave little moves. This one here, when we came to it, boom, we took off, right? So this is a 50-point move on ES, just for quantifying sake to explain how big this is. Another thing that we haven't really talked about so far on footprint charts is these zeros, right? So I'm not going to get too in depth on this. Yes, Almighty Beard Man, look at ES. If you trade MES, that's fine. Look at ES. So these zeros basically just means that the auction was completed. And we created a buy-side imbalance here. This is one thing I don't like about these charts is I would need to have basically, again, this is 600% greater than 27. 32 is 900% greater than 0. But since these are not both either 600 or 900%, it didn't make a box going across, which I think is ridiculous. It's like, this is an imbalance. But because it's different percentages, it's not creating a box. And actually, I should actually send a message to Quantower about this. They should fix this to where if we have a double stacked imbalance, even though the percentages are different, it should still print a box going across. But so this is one we would have to put on our chart manually. But so if we look at the candlesticks, like here, for instance, we don't have a completed auction here because we have a 158 and 11, whereas here we have 32 and 0, right? So this is a completed auction where the next time price comes to there, we would expect them to bounce. This is an incomplete auction or like a poor low. The next time price comes to there, we would expect it to break through, right? So like we were talking about at the beginning of the video, for every transaction that we have on in the stock market, we need a buyer and a seller. Here we had buyers, there were no sellers, right? So these buyers were not able to, or these buyers absorbed all of the sellers until there was none left. Okay. For this next part, so like I mentioned, this is taken directly from, like literally copy pasted directly from Trader Dale's book called Order Flow, which I linked in the chat. I just figured there's no point in me retyping something that's already been typed very well. So trading setup number 1, volume clusters, we talked about this, but this just goes more in depth, like on exactly what it is that you want to be looking at. So this setup is based on on trading significant areas of heavy volume, which occurred either in a trend or a strong rejection of higher or lower prices. And I'm going to quantify this in a second, just so you guys know. I mean, we kind of covered it already where we showed the volume clusters where, actually, maybe I can do this really quick. I don't want to go backwards on this presentation because I'll probably mess it up. I am not like a professional with Excel. But so we talked about these volume clusters. Here, I'm bringing it up on the screen. Where we have the large volume clusters, multiple candles closing below, we come back to it. You enter in the same direction, right? So that's what we're talking about here in a strong rejection of higher or lower prices. Such heavy volume areas are places where the big guys, institutions, and their trading algorithms placed a large portion of their orders. So talking about the situation with the volume clusters in a trend, we've already done that. Or sorry, no, we didn't. We did it in a rejection. This strategy, we talked about this, doesn't use bid and ask. We're combining the two together, right? So volume clusters within a trend, this is going to be very useful for a lot of people because when you have trend days, for people like myself that are reversal traders, it can be really hard to find an entry for trades, or even days where we're just, kind of running or selling off. It can be very hard for people like on those pullbacks to figure out where to enter into trades. Excuse me. So you're going to set your order flow software to volumes, just like I showed you guys. I'll pull it up again really quickly. To ours, it's called single, not volume, but same thing. Okay. It makes it easier to identify the heavy volume zones. This way, the order flow will show shades of gray and heavy volume areas. For ours, it doesn't show gray. It'll be darker, I don't know, blue, green, whatever. And then also, of course, our POCs are going to be the heaviest volume traded, and those will be yellow. I will say, if you want to use specifically Trader Dale's stuff, you can get a Ninja Trader and buy his indicators from him. And then you could use, like your colors would be the same that he's talking about. So find a trend and look for dark gray areas, or in our case, blue or darker green areas. Those are going to be our heavy volume clusters that stand out. Those areas represent heavy volumes, institutional activity. You need to see the price move away from the volume cluster, making it at least one or two whole footprint candles above or below the heavy volume area. I like to use the 30-minute footprint chart for this. Then you will need to wait for a pullback. When price returns back to this heavy volume area, you enter your trade. And so here we're going to show an exact example. Again, I don't have the ability to go back right now due to the contract change. So I had to use an example from Trader Dale's book. But this would be an example of a volume cluster in a trend where price is moving down. We have the larger volume of trades occurring here. This is something that I don't trade. I don't know what he's looking at here, but for me, like, this doesn't look like a large order because I'm mostly watching ES and NQ where we see thousands of trades occurring. But if you compare his candles to other candles, we definitely have a higher volume of orders here in this level. And so when price moves away and we have our two candles below, and again, these are 30-minute candles. In this case, we have three that opened and closed below our level. When price comes back to there, you would be entering short in this box, right? So you'd probably want to get in right here. You're going to have a little bit of drawdown where you're red on the trade. But then also, we will talk about this, but where to place your stop loss based on entering trades like this. You're going to want to hide it behind this large volume cluster, meaning like price might be, your stop loss might be up here somewhere. That way, if price does push through and break through this large volume cluster, it basically isn't invalidated your trade. And at that point, you would get stopped out. But you don't want to be stopped out before they get through this large volume cluster, because that's our key resistance level, right? Institutional activity. Unfortunately, I didn't have like amazing examples that I had already screenshotted. And I feel like I'm going to have to show you guys exactly how to find these because it'll be hard for me to just explain it. So I'll pull up my actual trading software and show you guys in just a second. But over here, there's this little funnel, I guess, next to size. Or actually, this is a better example here. There's a funnel next to size. You can click this. I did not mean to do that. Let me go backwards. Okay. I didn't mess it up. But you can click this funnel and a little window will pop down that lets you... Actually, maybe I can just show you guys really quick instead of talking. So here, if I click this, it gives me a filtering option, and I can filter what orders I'm seeing. So right now on ES, I have mine set to 20 or more. And what this does is it shows you where the large buyers or sellers are coming in. But again, we have the issue of, sorry, now let me get back to this. We don't know, right? So we have 400 orders at $7.93 and a quarter, buying as prices moving up, right? To me, that sounds like a limit sell order. Most people are not buying when price moves up, but sometimes they are. And then right before that, right, we have another large order for 400 contracts at 57.92 and 50 cents. Same thing, buying as prices going up, right? To quantify how much money this is, just to tell you what kind of a whale we're looking at here. So the same math we were looking at earlier. So every 25-cent move on ES is going to be $12.50. Multiply that by 4 to give us 1 point. That gives us $50. You would multiply this by 57. We'll do the cheaper one. 57.92 and 50 cents equals $289,000 for one contract. Now, if we multiply this by 400, that's $115 million, or basically $116 million order that was placed by whoever this is. And technically, since we have two orders for the same amount coming in so close together, it's safe to assume that their order was $232 million, right? These are the people that we want to follow, right? When you see massive orders like this come in, what you can do is, if price moves away, or this is going to show up as our large volume that we were talking about. Let me just pull it up again really quick so I'm not talking or just talking. That's going to give us that large volume node, right? Where we're going to see massive amounts of orders at a key level. And what we do is, if price moves down from there and we have two full body candles closed below, when we come back to this price, we want to be entering short or getting in puts. If we have two full body candles, price moves up, two full body candles above, and then we come back and retest it, we would want to be entering calls or entering long. Okay. So again, $232 million order right here on ES. We're just about done with the class. This last part, I'm just literally going to reference Trader Dale's book, because it's just way too much to type out, way too much to copy and paste, whatever else. And it's done so well in the book that there's just no reason for me to try to create footnotes or whatever, cliff notes, or summarize what he's covering. And again, like, some of you might look at this and be like, oh, like, he's literally just reading from a book. Yeah, I mean, most people teaching education stuff are taking it directly from a book or somewhere else, and basically adding their own, interpretation or whatever else it is to it. I definitely have not verbatim taken this from Trader Dale's book. But like I said at the very beginning, definitely read his book. There's so much good quality information in there. So first, we're going to be talking about the volume cluster within a rejection, which we just kind of covered, but we're going to look at it again really quickly. We already kind of talked about the step-by-step guide, but if you want to revisit this is page 51 of his book. But again, just read the whole thing, right? So within a rejection of lower prices, so as prices pushing down, we get the large volume cluster here, which is our support level. And the next time price comes to there, we'll be entering long or calls, right? So I'm not going to read all of this verbatim. I would recommend either going back and rewatching this and pausing this and reading what he's saying, and then pausing here and reading what he's saying. But I just want to show you guys really like the illustration and an example of it happening on the charts, so that you can, turn around and use this in your trading. Almighty Beardman has a question. So, oh my gosh, can I show what trapped sellers and buyers look like on the footprint chart? Yeah, it's really imbalances where you're seeing a lot of orders on both sides. And the issue is, with me trying to show you, is I don't think I have a great example. And again, with the contracts changing, I don't know that I'm going to, I wasn't able to find a good example, which is kind of specifically why I didn't talk about it. I mean, I think this is probably the best example that I have. And it's where we have that negative delta, which is basically saying negative delta on a green candle, which is saying that the sellers are really showing up aggressively. Oh, and actually, I'm glad that I just used that word. I'm going to backtrack way back, and I apologize for doing this, but it's important information. When we were talking about, if there's, like we always need a seller or a buyer for a transaction to happen in the stock market, then what causes price to push up versus price pushing down or price staying flat? And what that is who's the aggressor, right? So if I'm buying at the ask, then I'm willing to pay more money than what the actual bid is. Or if I'm selling at the bid, then I'm willing to sell cheaper than what the ask price is. So basically, it's whoever's more aggressive. Like if I'm willing to pay more money to get into the trade, in that instance, I'm the aggressor. If I'm willing to sell my contract for cheaper than what the current price is, the ask price, then in that case, I'm the aggressive seller. So hopefully that makes sense to everybody. What moves the market is aggression. So if the sellers are being more aggressive or if the buyers are being more aggressive, basically if it's a buyer, they're willing to pay more. If it's a seller, they're willing to sell cheaper. Those are the people that move the markets. But so in this instance, we can't see the exact amount, but I know this is at least 1,000 and this is at least 2,000. Same here, 1,800. And we're having, people showing up on the bid and the ask. And again, this could be, or not could be, it is going to be a combination of aggressive buyers and sellers and limit buyers and sellers, right, on both sides. So this is how those trap buyers show up on the footprints. Like this is the best screenshot example that I have, but I don't think that it's the best example. And maybe in the future, when I see a good example, I'll hit you up, Almighty Beard Man, or I'll at everybody in my channel and show a better example of that. Okay. So then next, I think I wanted to go page 51 all the way to, let me see, sorry, to 58. Yeah. So here's our volume clusters with a rejection, or I don't know why he's calling this a rejection. This is a bounce. Reject at the top, bounce at the bottom. I don't know. Key terminology for me, just because I trade live, and when I trade live, I don't want there to be any confusion. So if I say we're going to bounce here, we bounce up, right? Like price doesn't bounce down, right? Like we can't bounce down. If we're bouncing, it's always going to be up. If we're rejecting, it's always going to be a move down, right? So I don't like the verbiage here, but Trader Dale is not a native English speaker, so it's okay. But just for me, if you're trading with me, always know a bounce means up, rejection means down. So in this case, price came down. We created a large volume cluster towards the bottom of the candle. The next time price came to there, you would enter long or enter calls. I'm assuming he probably closed his trade here, and we'll talk about that in a minute, but I can see why he would have closed his trade here. I don't know what indice this is that he's trading, but a lot of these where you have, the 1,000 point whatever, this is a big move. It might not look like much, but it's a really big move. So next, volume cluster in a bounce. We have that large volume cluster. It's actually over 2 candlesticks here. And then the next time price comes to there, you would enter long, right? Volume cluster with a rejection. Yes, this is a rejection down. So we have our large volume cluster here. I guess on the previous examples, I wasn't talking about, our candles opening and closing below the level before we retest it. But once we retest right there, you would enter short. In this instance, you would have been negative on your trade for a little bit before it went in your direction, right? This would be, again, a rejection, and it happened a few days later. So these are key things to know. When you see these large volume clusters, you want to put, like a mark on your chart saying, hey, large volume cluster here. The next time we come to there, I want to short it, or whatever information you need to put on your chart. So when we came back to there a few days later, we did have some drawdown and then a massive move to the downside. And kind of the same thing that we're seeing here. Like they got a big move from there down. And it looks like it was, it went just about the same height, a little bit lower on the retest. Multiple nodes. I don't like how he has the high volume nodes separated, but even my mentor Shorty says it's okay if they're, like one square off. I try to look for them where they're parallel to each other. And I just realized, I apologize, everyone. I don't think I mentioned this, but when I was talking about, for me, like, this is one of the most frustrating trades to look for, because you don't see 2 high volume nodes side by side on a 30-minute chart during the New York session very often. But if you find one on ES, you're probably going to get a good 50-point move from there the next time price comes to there. If you find one on NQ, you're probably going to get a good 100-point move the next time price comes to that high volume node, or that high volume cluster, whatever. So the reason these are frustrating for me to look for is they don't occur very often. Kind of like the 80% rule. Those tend to happen about once or twice a week. These you'll probably see once a week at best. But when you do, definitely worth noting. They're definitely worth looking for. It's just, I guess, a little frustrating. Like looking for it, you don't find it. Looking for it the next day, you don't find it. Looking for it the next day, you don't find it. But once you do, it pays off. Okay. So hopefully that makes sense to everybody. Again, I would recommend, I would just recommend getting the book, but if you need to, pause and read. We're looking for those 2 high volume nodes side by side. And when that occurs, we want, 30-minute candles opening and closing below that level. The next time price comes to there, we would slap short or slap puts. And also, just to quantify this, for people that don't understand me saying like take puts, you can trade ES and take puts on SPY, or take calls on SPY based off of your ES chart. So if you find a double high volume node on ES, you can absolutely grab a put on SPY at this level. Or the inverse, if price went above, you can grab calls on the retest of this level. For NQ, you can do the same. You could take puts on QQQ, or you could take calls on QQQ based on the same information if you have access to these charts. Next, it's again just kind of the same information. This would be multiple nodes in a trend. So this is effective for where we're having like a trend day and you're trying to figure out where to get into a trade, and we're not getting like a nice retest of a key level. You find that high volume node in the trend, have full body candles, close below, retest it, you would enter short. Or again, if it's full body candles above, retest, enter calls, or enter long. Same thing. This is multiple nodes in a trend where we're already trending down. We have a large volume of high volume nodes in this same area right here. Price moves away from it. The next time we come there, you would enter short. This is that, high volume nodes. Looks like this is the New York session. Like 10 to 11 o'clock in the morning. And we just have a bunch of POCs stacked together. You're probably going to want to grab the highest one. So like in this instance, he's grabbing the highest stack right here. And when price came to there, he entered long. Multiple nodes before a trend where we're trading sideways here. And we've got this large volume here. The one thing I don't agree with on him here is, I guess these are stacked POCs. So decent to enter the trade there, but we also have large volume all the way down to this level here, right? Hopefully you guys can see that clearly. So if you want to make sure you don't miss the trade, it might be safer to get in right here. Just a heads up. Multiple nodes and a strong rejection of higher prices. Higher / lower prices. I was like, how is this higher prices? So we're coming down here. We create that double high volume node. Price comes back to there. You would enter long. I'm going to stop talking about this because it's the same thing over and over again. This here, just so you know, I don't use this, so I'm not going to cover it. Again, if you're interested in this, read the book, and you can see if it's something that piques your interest or something that you're interested in trading based off of. The next part we're going to talk about is heavy volume area, take profits. So how to figure out where to take your profit based on those volume nodes. And again, this is all directly from the book. So we're going to go to page 106. So he's not giving us maybe you took a short off of this high volume node up here at the top, and you're trading it down. And then here we have a high volume node at the bottom. The top of this, so I can't see exactly, I think it says 609 is where you'd want to take your profits. And you can see that's where we came and bounced to. But also, not only are we taking profits here, we're going to reverse and switch to longs, right? So if we were in a short or in puts from up here, we're going to come down, we're going to sell our puts or sell our short there. And then we're going to reverse and switch to long, because this is an area where we have a high volume node where we're interested in being long or being in calls, right? So hopefully that makes sense to everybody. I'll do that pretty frequently where I'll identify a place that I want to be in long or be in calls, and I'll identify a place that I want to be short or in puts, and I'll play it down to that level where I want to be in long or want to be in calls. And when I get there, close my trade and reverse to long or calls. I think that was the only, I might want to be looking at more. I don't remember on this. No, just page 106. And then the last thing is going to be 115. We're going to talk about stop loss with order flow. This is important. And also, if you were in my previous class, or if you weren't, you should go back and watch it. We also talked about stop losses based on, like strong lows, strong highs, um, poor lows, poor highs, things like that. So there's a combination of things that you can use, to get the information, to figure out where to place your stop losses. But today we're specifically focusing on footprint charts, we'll just say footprint charts. So again, actually I'll go slower, but if you want to read all of this, just, pause, go back or whatever, pause here, and then, pause here. But so if we're talking again about, we have this double stacked high volume node, right? So the next time price comes to there, this is going to be our resistance level where we're looking to enter into puts or enter short. And based on that information, that high volume node ends right around here, right? So it's kind of this whole box right there, if you guys can see that. So here we have like 271 and 216. And if price gets through there, they're invalidating our trade, right? So this is where we're interested in being net short or being in puts. And if they invalidate our trade and break through that high volume node area, then we can comfortably put our stop loss hidden behind that high volume node. And I know somewhere he uses that exact verbiage, and that's exactly how I was taught by Shorty. That's exactly what Trader Dale talks about, is we want to hide our stop losses behind key levels. So if we have a level where there's a strong resistance level, right, we want to be a little bit above that and hide our stop loss behind that high resistance level, right? Or the inverse, if we're in calls, we want to hide our stop loss below a key support level. So like, we'll just pretend the inverse, that this is our high volume node here, where we're coming back down to and we're wanting to enter long or get into calls. And this is our support level. We would want to hide our stop loss somewhere down here, below this 42 or whatever, to where if price gets back down to there, they've already basically invalidated a reversal at this high volume node that we were watching, or double stacked high volume node. And so at that point, we can comfortably be stopped out and say, okay, this time they weren't going to respect the trade. It's going to go against us. And we just take our stop on the chin and then look for the next good setup. That's going to be it for the class. I'm just going to quickly say, if you're, what was I going to say? Let me take a sip of water really quick. Sorry, 1 second. Basically just an extension of the class I did on volume profile, where I also talked about psychology a little bit. You're going to want to, or actually I just realized I'm not done with the class. I have one other thing I want to cover that's very brief and very quick. But I guess most of the education, like chart-wise, is done. But you basically have got to learn to be okay with getting stopped out of trades. Let me get this off my screen here. And then the inverse, you have to be okay with letting trades run to your take profit level, right? So whatever that looks like let's just say, for instance, I was long here on ES, right? And I identified, I'm just going to make up a fictitious trade, but let's just say here we identified a like a double stacked high volume node, right? That we want to be in calls based off of, or we want to be in, long based off of. Or actually, let's just say that wouldn't make sense, what I'm saying. This would make sense. And it's actually almost true, because these are, these green boxes are going to be imbalances that were there at one point in time. But anyway, let's just say here I have a high volume node, double stacked high volume node that I want to be in long off of, right? And then here I have a strong low, right? And so if I was wanting to take this trade, then I know I need to have my stop loss below that level, right? I didn't talk about strong lows today, but again, that was covered in the volume profile class. So if you missed it, go back and rewatch that. But so basically, I know if I want to be in this trade, for them to invalidate it, they would need to cross below this point for me. So if I'm entering the trade here, I need to use my long position tool and just say I'm getting into the trade there. I want my stop loss to be hidden behind this strong low, which then means like whatever, my take profit could be previous day value area high or previous day value area low. And in this instance, I'm getting 2.4 to 1 risk to reward. This is a trade that I could take. So we're using the information on the chart on where to hide our stop loss. That way, you know, if they break through this single print or high, why can't I think of the word right now? If they break through this single print or strong low, that's the word I was looking for, there's a pretty good chance that that my trade is invalidated. But I still want to give myself a little bit of room, because you'll notice a lot of times market makers will do shady crap like come down. They'll go just below this enough to say every retail trader that put their stop loss right at that level can suck an egg, because they'll come down, grab your liquidity, and then they'll run. Okay? So stop loss just slightly below or slightly above key levels. And then our take profit, we're always going to be targeting a key level. I didn't really explain like a reasoning for why my take profit is where it is today, but we did cover that on both like when I taught volume profile, and we also covered it today with like our high volume nodes or the areas where we have, you know, large amounts of order flow coming in on the charts. So the last thing really quickly that I wanted to cover for you guys is I said I would give the excuse me, I don't know why I can't English right now, but that I would give you guys my cluster chart settings. I don't know why this is like all zeros, but whatever, it's not loading right now. The market's closed. Oh, there it goes. These footprint charts or cluster charts can be pretty, what's the word? Finicky when the market's closed. But when the market's open, they'll load right away most times. But when the market's closed, it's a little bit hard to teach classes because sometimes you won't get the bid and the ask prices. But so one of the things that I wanted to show you guys really quickly, if you're using Quantower, and again, I'm going to cover how to use it if you're wanting to use your own cash and how to use it if you're wanting to use a prop firm. But basically, if you want to see the order flow showing up here, which is where I was talking about those large orders that you saw where it was like 400 contracts traded at one time, you have to highlight the current candlestick to see those orders coming in. So like right now you can see this candlestick is highlighted yellow. Again, it's one of my slight pet peeves with Quantower, but it's the best solution that I have. Every 5 minutes I need to, click, click, click. And then you'll see the order flow coming in over here. And again, I covered this, but you want to filter it. If I put it to 1, this is going to move so fast. I'll see every single retail trader's ordered, that I won't catch those big orders, that are whatever, 400, 500, whatever lots. Even if it's a 50 lot, that's a huge order, just an FYI. You're not going to see a ton of orders that are 400 or 500 contracts like I showed you. But when you do see those orders, definitely pay attention. Even 20 orders is a lot, or 50 orders is a lot. Another thing I didn't mention, but that does need to be talked about, these zeros, if you see like 3 of them in a row, you can kind of confidently slap sell, or like market sell and get in short, and you're going to get a massive move. So like in this instance here, we have double zeros at the bottom. I prefer to see 3, and you have to be really quick with your order, because once you see this, it just starts flying. So in this instance, it's this is a 5-minute candle that went from 613 to 633. So like a 15-point move in 5 minutes. If you see 3 zeros, like it's going to rocket. You'll probably get like a 50-point move, or I should say 3 or more. It's not like the, what's the word I'm looking for? Like, it's not the highest confluence trade in the world, but generally when you see like 3 or 4 zeros in a row, you're going to get a massive move from there up. If the zeros are at the bottom, you're going to fly up. If the zeros are at the top, you're going to dump. Okay. And then what I'm going to show you guys right now is how to apply the template to your chart. So if you go to your chart in Quantower, and I will say I do have videos on Quantower on my YouTube channel, but if you right click up here, I think, yeah, basically right click anywhere up at the top here, you go down to apply template, and you would select the one called Drew, because that's what it's called when I upload it. And that would apply the same settings to your chart. And if you're interested in, like your cluster chart, right now mine's set to imbalance, where we see the bid and the ask. If you go to single, that's where you would see those large volume blocks. Okay. Or here we have a large volume block at the bottom. So yeah, I don't really know if I'm, yeah. Here we have a double, but it's on the 5-minute. Anyway, that's how you get to this chart, where you just see all of the volume traded as one number. And basically I just reference this, and I'll mark zones on my chart, and then I'll switch back to my imbalance chart, because this is what I like to trade off of. But so anyway, I'm going to post the template in the Catching Rockets channel, I guess, because I don't want to spam anywhere else. And you guys can download it. And when you download it, you're going to go to wherever you have Quantower installed. And again, in just a second, I'll talk about like where to, what brokers to use if you're wanting to use Quantower as your trading platform. But so for me, downloads, Quantower Top Step, you'll go to settings, and then into templates, and you'll literally just drag and drop this into there. And once you've done that, then you would open up Quantower. If you drag it there before you open Quantower, it's not going to be, I mean, if you drag it there after you've opened Quantower, it won't show up as a template until you go back and what's it called? Restart Quantower. So I am currently pasting this in my channel. For anybody that wants it, you just click the little download arrow. I'll just show you guys really quick. Well, so here you just click this little download, and it'll download it to your computer. And then I guess also something that I need to specify, Quantower is only available for Windows-based computers. So you need a Windows PC to use this, which might not be ideal for some people, but most trading software is geared towards Windows. And if you're wanting to be a trader, and I'll just say this really quickly, because I'm not trying to like put anybody down or make anybody feel bad. But when I started trading on a phone. And then from the phone, I switched to like charting on a tablet and trading on my phone. And then from there, I slowly graduated to a Windows-based computer with, I think, two 27-inch monitors. Yeah, not I think. I had two 27-inch monitors. And then I eventually went to a 49-inch ultra wide with my two 27-inch monitors as well, and just kept like, reinvesting what I was making into my trading, and basically getting a better and better system. I don't know why this isn't showing up. I guess it's because the market's closed. But just to show you guys what you're looking at kind of thing, over here, I have my delta. So if we go to right profile, you can see delta full view current month. You can change this if you want to yesterday, the current week, previous month, whatever it is, full chart range. And this just shows me an overview of the delta. And then also the yellow bar is going to be my POC for the delta. And then again, these show up as green and red. That's just telling you like, was the bid being hit more, or the ask being hit more, and so on and so forth. The way I can tell is if this is buy side or sell side delta is what price did from there. So like, especially if we switch to like current day or something like this. I guess I can't do that. No, that's frustrating. Yesterday? No. Yeah, I guess yesterday was Saturday. But anyway, if we switch it to like more real time, you can see like this here was obviously buyers, right? Because from there we bounced. Here, buyers, we bounced. I mean, obviously both are happening, but the aggressor here was buyers, right? The aggressor here was buyers. The aggressor here is also buyers, right? Same thing. Here, the buyers are stepping in as well, right? Here we have buyers stepping in at this node as well. Here, from here, we created an imbalance, but in the middle of a trend. We're not interested in this, even though it worked out. But here we have buyers stepping in, right? So that's how you look at delta, whether it's, buying or selling. And I like to leave it on current month, or even previous month is good. You can do a combination of both as well, right? We can't see it right now because the market's not open, but my left profile is going to be volume, full view, and today. I guess if I did like this, we'll see it. This shows my volume profile, right, for the current week. And this would be the value area low. This is my POC, and this is my value area high, right? And under settings, I mean, you guys, I gave you guys the template, so it's going to be the same anyway, but you want to set your value area volume to 68, right? So the only other thing I want to talk about really quickly is brokers. Will I stay for market open? No, I'm not staying for, I mean, I might be because it's opening in 4 minutes, or 2 minutes, I'm sorry. But no, I'm not going to be trying to trade right now. I'm not even ready. I haven't charted anything. And I also need to go live and do my SPY update for tomorrow. So I'm pretty busy right now. I also need to eat. I haven't had lunch yet. So I opted to do the class instead of eating lunch. So really quickly, the last thing I want to talk about is the brokers. So I guess I have to log in to show you guys this. So one broker you can use, this is the one that I recommend if you want to be using a prop firm, is going to be TopStep. And I generally recommend going with the 50K account. But if you click here, it's going to give you a list of brokers that you can use, and one of them is Quantower. So you would make sure you select that, and then finish the sign up process. And then the reason I recommend TopStep is they give you free access to the premium indicators on Quantower. And so I'll show you what that means. If we go to quantower.com, go to their pricing, their all-in-one license costs $70 a month, and it's included for free if you're using TopStep. If this is something you plan on using for a long time, they also have a lifetime where you can just buy it outright for $15.90. So if that's you, like, go for it. But if you're wanting to use a prop firm and not have to pay extra money for the, what's it called? For your, the all-in-one license, then TopStep is the way to go. If you're not wanting to use a prop firm and you want to use your own money, then there's something very specific you have to search for, but it's AMP Futures Free Quantower. So if you go to Google and type in AMP Futures Free Quantower, the first link that comes up, I don't know why, like my spam filter or whatever marks this as a spam website, but it's not. But anyway, if you come here, using specifically that link, and I can link this for you guys really quick, but again, you have to use this link if you're wanting to get the free Quantower. You go to this link, sign up, and you have to deposit, I think you have to deposit $100 or more, but you're going to need more than that to trade futures anyway. But there is a minimum deposit amount to get access to the free Quantower, but you're going to be depositing, or you should be depositing more if you're trying to actually trade futures. So sign up through this link. Again, specifically, I shared it in the chat. And this would be for if you're wanting to use a cash account with Quantower. Okay. Hopefully this was an informative class. Hopefully I've answered everybody's questions. Am I confused? Does the market not open right now? Or did we gap? Oh, we gapped huge. Wow. And then right to a buy side imbalance, right? I want to see where this one originated from. Because, I mean, it's got to be way back, right? We came to here, 59.64, right at the beginning of a trend. So now you guys get to see live, like, kind of how important these imbalances are. Even with gapping down with massive selling pressure, right? This should show you guys the power of imbalances. And then also, well, this is the POC for today. But so, yeah, this was a 600% higher volume than these, created this pretty large buy side imbalance at the very beginning of a trend. And from here, I mean, we got a massive move to the upside, right? I don't even know how far this is. So that buy side imbalance, it looks like it went over 100 points. No, I'm wrong. It was 596 something. It's like 75 points, give or take. right? So huge move from that buy side imbalance, which was created at the beginning of a trend. Yeah, and about 75-point move, give or take. Just shows you the power of exactly what I'm teaching right now. And actually, really quickly, while this is live, let's just look and see if we can see any large orders coming in. Where are you? Actually, I can force it to show us orders coming in. So if I select this candle, it's showing, oh, none. But if I select the current candle, which is what I was telling you guys, basically we can switch the size. This is going to make your brain rot, but here you go. Well, here's a 16 lot. That's a big order, but you can see how quickly this moves if you're not filtering this. There's a 20 order. It's especially during New York session. This is, like pre-market on a Sunday. There's a 36 lot. But so filtering this is pretty important, so now just filtering it to 10, I can see a lot more of the large orders. And if I'm wanting to see less of those smaller, large orders, I can filter it further, and that gives you an idea of what you're watching. And again, let's see what that was. 23. This will just melt your face watching this. So good times. Yeah, filter the orders to limit how much you're seeing. And then also just really quick while I'm here talking, I'm going to be trading live tomorrow morning. So I will see you guys then. I'll post a link sometime fairly soon. But I'll be live at the market open 6:30 in the morning or 9:30 Eastern, 6:30 Pacific Standard Time, my time. With that said, much love, much respect, everybody. I hope the class was informative. Hopefully you guys learned a lot. And just apply it to your charts. Really, if you take volume profile and order flow, whatever footprint charts, combine the two, either use the setups that I said are standalone as a standalone strategy to enter trades, or the setups that I said are, like confluence trades where you would use confluence with volume profile. This is where trading starts to get a lot easier. And you're not, guessing so much like, oh, is this a good place to short? Or is this a good place to go long? Or is this a good place to buy puts? Or is this a good place to buy calls? Everything starts kind of coming together. And this is what I would call like basically unlocking the matrix, where you can actually see what's happening behind the scenes, behind the candlesticks, and, get that information for you, right? Right now, just to kind of show, we have a large volume cluster right here, right? So if we switch to our single, you'll see this is all large volume cluster, right? And then it even extends over here where it's kind of both of these here. So if we have, 2 30-minute candles that open and close above this area here, we would want to be getting in calls at 559.87 when we retest that level, which also kind of happens to be today's POC. Well, developing POC, right? This is still being developed, but for right now, that's our POC for the day. Okay. Kind of cool that you guys got to see some of this stuff actually playing out live. Good stuff, fun times. Anyway, again, much love, everybody. Much respect. I hope you all have a good rest of your weekend. I'll probably be live, 30, 45 minutes. The plan is to just wipe my SPY chart, start fresh. As long as I still feel like I have the energy to do it. When I get to that point, I'm sure I will, but I'm just kind of putting a little possibly not going to happen on that I'm wiping my chart thing because it's a lot of work, but it needs to be done. I need to do it on my ES chart as well. Oh, and while I'm talking about it, you should do it like roughly every 3 months on your SPY chart, just an FYI. Anyway, much love, much respect, everybody. Have a good rest of your weekend. For those that tune in for my SPY sessions, I'll see you in about 30, 45 minutes. Take care.